The next discussion today is efficient market hypothesis and arbitrage pricing theory. And then we look at a few global market instruments. So with that, we will end up our discussion. Efficient market hypothesis is given by Eugene F. Farmer. Eugene F. Farmer in 1960s. He was given Nobel Prize in 1993. Currently, he is the Professor Emeritus in University of Chicago. We have requested him to address our students because of through online lecture he can address. We requested him, but I have received a reply mail from him stating that I have requested in the month of June. Let me try. We'll try once again. Let us get him through online lecture for this particular theory who was proposed by Professor Eugene Farmer, efficient market hypothesis. We look at what is that. So what is called, he said, efficient market is a market in which the stock prices are unbiased estimate of intrinsic value. So look at that. He said efficient market efficient market EMH, that is efficient market hypothesis, proposed by Eugene EFF, that is Eugene F. Farmer, who got Nobel Prize in 1993. So according to him, every market is an efficient market. Efficient market is the one in which the stock prices reflect unbiased estimate of intrinsic value of a stock. That is, it's reflecting, stock prices reflect unbiased estimate of intrinsic value. Intrinsic value means the book value of a particular stock. Intrinsic value means book value. Intrinsic value, or call it book value. So what is book value? So book value means based on balance sheet. Based on balance sheet, what is the value of a stock? That is called the value of a company based on fundamentals. So based on the business performance, what is the value of a company? That is called the intrinsic value or book value. So how do we get that? We have seen earlier. We have seen the initial part of our discussion, book value or intrinsic value. When we have looked at the primary market, secondary market, we have seen that. So book value means the total assets minus total liabilities. So what is total assets here? Fixed assets, investments, and current assets, loans and advances, minus total liabilities. Here total liabilities means outside liabilities. That is secured loans, unsecured loans, and current liabilities and provisions. Okay, so divide by number of shares in the free float. That will give you the book value or the intrinsic value. So when you look at any stock price, moneycontrol.com, you will be given both intrinsic value, that is book value, as well as the market value. So stock prices reflect unbiased estimate. So the book value cannot be biased. Okay, the stock prices, the market stock prices reflect unbiased estimates. So there are deviations. See, for example, the Tata Motors, when you take the book value, say 800, Tata Motors book value say 800, the market price is say 920. Okay, say 920. So this is a deviation. So what should be the market price? The market price should be in and around 800. The market price should be in and around 800 because that is your business performance. Whatever the market price should reflect the business performance of a company. But there may be deviations. So that deviations are unbiased. So those deviations are random. It is nobody can influence that deviations. So that particular market is called efficient market. So every market today is an efficient market because market absorbs the information. The moment any information comes, the market absorbs the information. So that information can be private information or public information. So private information means the current particular, the company, CEO of the company is leaving, any specific to a particular company. That is called private information. Public information means GDP growth rate, the COVID-19 pandemic cases, air crash or interest rate fall, the dollar depreciation, rupee appreciation. These are all called the macroeconomic factors. This we call it as the public information. So you have private information and you have public information. So these private information cannot be influenced through the market price. So that is called the weak form of efficiency. So efficient market hypothesis is, there are three different categories. One is weak form, semi-strong form, strong form. The weak form is the private information cannot influence the market price. Semi-strong form means public information cannot influence the market price. And the strong form means both private information and public information cannot influence the market price. Okay, so all these informations are freely available in the market. So market absorbs information. So there are deviations because, for example, a book value say 800 and the market price is say 920. So there may be deviations. So these deviations are not intentional. These deviations are unbiased. Nobody can influence this deviation because the market is the software driven. So nobody can, unlike earlier, we have the outcry system. So in the outcry system, people come here, we will come to the trading floor and they buy and sell. But today, a buyer and seller cannot meet each other. Buyer and seller cannot meet each other. So a buyer can be from Los Angeles and seller can be from Bangalore. So buyer and seller will not meet each other. So in that scenario, every market absorbs information and every market has these deviations, but these deviations are random. That's what we call it, random. Random means nobody can influence any market prices. Okay, so that is what he is given, but he could not use any model for using for testing this particular efficient market, but he has given in contradictory to the technical analysis. So as per technical analysis, what does the technical analysis says? Technical analysis says through charts, through pattern, through looking at the patterns, we can predict the stock price. Stock prices can be predicted by use of charts, by use of graphs. But efficient market hypothesis says no stock price can be predicted. No stock price can be predicted tomorrow because stock prices reflect unbiased estimate of the intrinsic value. So stock prices cannot be predicted. So he has given that contradictory view of the technical analysis. So for him to took time for him to get a Nobel Prize because he has given a contradictory view. So it is given in the LMS. The detailed information is given. I'll just run through what is given there. Look at that. Efficient market hypothesis definition is given. This is what you need to approach here. Okay. So write definition. You write forms of efficiency, weak form, semi-strong form, and strong form. You write that. And then what is efficient market? You just write that. Efficient market is a market in which securities reflect all the possible information quickly and accurately. So to have an efficient market, we must have many knowledgeable investors actively analyzing and trading the stocks. Information is widely available to all the investors. Events such as labor strikes, accidents tend to happen random. So investors react quickly and accurately to the new information. So they react to the information quickly. So the efficient market hypothesis is a theory supporting the notion that market prices is in fact, it is fair market. So under EMH, the security prices fully or fairly without any bias. Nobody can influence the market. That's called the unbiased. Nobody can influence the market. Reflect all the available information about securities. So in 1960s, it has been given in particular market. So it is given very clearly. The efficient market is a one in which the market price of a security is an unbiased estimate of its intrinsic value. So intrinsic value here means the book value or the value as per the balance sheet. Okay. So the market efficiency does not imply that the market price equals intrinsic value at every point. So it will not be equal. Market price will not be equal to the book price or the intrinsic value. So there are deviations. Deviations will be there. Okay. So if it is more than that, the book value is this should be the value. So book value should be the correct market price. If it is higher, then the particular stock is overpriced. It is overpriced. If it is less, it is called underpriced. So book price is the benchmark. Book value is a benchmark. So any market price is higher than the benchmark, that means it's overpriced. Okay. So book price is the benchmark. If it is less, the market price is less, it is called underpriced. So what does this particular comparison between market price, book price give you? What kind of clue we get? The clue is overpriced stocks should be sold. Overpriced stocks should not be kept in the portfolio because these stock prices will fall in the future. Underpriced stocks, we need to buy more because these stocks will tend to move higher in the future. So we need to keep more, we need to buy more underpriced stocks. So there may be deviations. So these deviations are random. So what is called random? If you take some balls are kept in the basket or some cards are kept in the basket. So you take one card or you take one chit or you take one ball. Okay, so that is called random. Okay, so you take you want to take a particular ball, then the particular action is not random. So random means you mix it up and take one chit. That is called random. Okay, so here what is called randomness? Here the randomness means the market prices are moving without the influence of any information. Without the influence of any information. The information can be private information or public information, or it can be both. Private information means weak form, public information means semi-strong form, both information means the strong form. Okay. So it says that errors the market prices are unbiased. These deviations are unbiased. So nobody can influence these deviations. So this means that the price can deviate from the intrinsic value. The price can deviate from the intrinsic value. It can move either upwards or downwards. Okay, so these moving upwards or downwards, these deviations are random. Nobody can influence this deviation. If anybody influences the deviation, that means the market is not efficient. The market is not efficient. Okay, so nobody can influence these deviations. The deviations are random deviations and uncorrelated with any observable variable. So no private information or public information can influence the market deviations. So that is called efficient market hypothesis. So you should write what is the forms of efficiency, weak form and semi-strong form, what prices reflect. All the weak form means the private information about the particular company. Public information means any macroeconomic factors. That is called the private information. So you look at the weak form and charting. These are all charting because it is contradicting the technical analysis. Technical analysis says market price can be predicted in the future. It can be predicted, but efficient market hypothesis says if it is predicted, the market is not efficient. So if anybody comes to know that, if anybody says tomorrow market price can be predicted, that means it is biased. Somebody is influencing. That means the market is not efficient. Okay. So semi-strong form, it is any corporate announcement. It can be stock split or cash in dividend or stock dividend. This is called the strong form. The strong form means both private information and public information cannot influence the stock price. Then give the criticism. So write what is efficient market, and then you write what is a weak form, a semi-strong form, and strong form, and write the criticism about a particular theory. So this is about efficient market hypothesis. Then we have arbitrage pricing theory. Arbitrage pricing theory. We call it APT. Arbitrage pricing theory. Arbitrage means what? Arbitrage means the price differentials in the market. The price difference in the market. So when you look at Sensex and Nifty, Sensex prices and Nifty prices may not be always same price. There may be some difference, some minor difference. So you look at Tata Motors, or you take any stock, any company. So any company price, when you take Sensex value or Nifty price value, both the markets when you compare, so there may be slight difference. It can be 5 paise or 10 paise. So what do people do? They buy from the low at lower price. So wherever the Sensex, if it is low, they buy from the huge quantity. So you buy say 10,000 shares. When you are buying say 10 paise difference, you will get 1,000 rupees in one shot. So you buy from one market and sell in another market. But we are taking a very extraordinary risk that we are taking. Very high risk that we are taking, because you are buying from one market and selling in another market takes about say 10 minutes. So here you need to sell and then you need to buy from another market. So it takes time. So during that particular difference in time, the price will increase. So in such case, we will be losing our money. So arbitrage here means, so that is the price difference. So these price differences should not be in very high. The differences should not be very high. If there is a very high differences, what will happen is there may be differences, but these differences cannot be very high. If it is a huge difference, what happens is people tend to buy from one market and sell in another market. So that is about the arbitrage pricing theory. So you can write what is arbitrage. It is given in the LMS very clearly. What is arbitrage? And what are the various factors which influence arbitrage? It can be macroeconomic factors, as I was discussing earlier, employment rate, interest rate, the appreciation of dollars or depreciation of rupee, then GDP values. So these are all the macroeconomic factors. If the macroeconomic factors affect stocks in different prices, so the same prices would remain same. If it is remain same, both are different markets, then the arbitrage does not exist. The arbitrage exists only when there is a price difference. The price difference tend to occur. The price difference tend to occur because some market absorbs the information very quickly and some market takes time. Okay, so the arbitrage is always there. The price difference is always there, but the price difference should not be very huge. Okay, so price difference tend to occur because of these macroeconomic factors. So you need to write what is arbitrage and what are the various macroeconomic factors and what are the assumptions of arbitrage pricing theory that we need to write. The assumptions of arbitrage pricing theory is more or less same with the CAPM assumptions. Then we need to look at the global market instruments. So you need to have a little idea on various global market instruments. We have few, that is depository receipts, DRs, depository receipts. Okay, so we have depository receipts. It is there, all there in the LMS. You can see in LMS. Okay, so one is ADR. Another one is GDR, Global Deposit Receipts. Before I take up deposit receipts, we need to clarify a few fundamental questions. Why do companies come for a market for raising? Why do companies come to raise funds? Okay. So the companies come to the market for enhancing its capabilities, production capabilities. So why the company should come for diversification? The company should move forward. So it should move forward horizontally or vertically. It can be horizontal integration or vertical integration, or it can be horizontal growth or vertical growth. So when the company comes for diversification, the company should have funds. So how does a company raise funds? There are so many ways. Either we have equity or debt. Either you can either you issue you raise funds internally, contributing by your own shareholders, or you come to the public market. So you come to the issue. Okay. So when the company is coming into the domestic market or Indian market, you issue equity. You issue equity shares. Now, a multinational company requires, for example, Infosys or TCS. These are all Indian multinational companies. Indian multinational companies, they operate not only in India, but they operate in, for example, TCS operate more than 35 countries. 35 countries. You have an office in Singapore. We have office in Washington. So they have 35 offices all over the world. So TCS is not only Indian company, it's an Indian multinational company. So Indian multinational company requires not only Indian rupee, but also they require foreign currencies, because they deal with multinational transactions. If you require rupee, then the company can issue equity shares within the country. A Indian multinational company requires dollars or requires foreign currencies, then the company can issue depository receipts. So depository receipts are form of equities for rising foreign currencies. So Indian multinational company issues ADR, American depository receipts, then the company can raise in dollars. So whoever is buying, any American who is buying these deposit receipts, they invest in dollars. So the company gets in dollars. For example, here if you buy share, you pay rupee and then receive the shares. The same American, if he buys the share, he has to pay in dollars. So that is called deposit receipts. So deposit receipts are another form of raising funds. In foreign currencies by an Indian multinational companies. Indian multinational companies can raise foreign currencies through issue of deposit receipts. But they are also known as the shareholders. But the difference is they do not have voting rights. If they have voting rights, what happens is they will have a control over our Indian multinational company. So the holders of deposit receipts do not have voting rights. They cannot take part in decision-making process of our company. But they are entitled to receive dividend. They receive dividend in the form of dollars, but they cannot be part of decision-making process. They cannot be part of ordinary resolutions of a company or special resolution of a company, because they cannot take part in decision-making process. So they do not have voting rights. The same multinational company issues any foreign currency. They can issue in yen in Japan, or they can issue in pound in UK. Then it is called global deposit receipts. Global deposit receipts. We call it GDR. GDR means it can be issued in any foreign currencies. That is called global depository receipts. So deposit receipts are the form of equities for it is given for multinational company for raising funds in foreign currencies. It's called ADR and GDR. Both ADRs and GDRs do not have voting rights. Now, a foreign company, foreign multinational company, can they issue deposit receipts in India? The previous one what we have seen is an Indian multinational company can issue deposit receipts outside the country. Now the question is, can foreign multinational company, can they issue deposit receipts in our country? That is called IDR, Indian Deposit Receipts. That is, foreign multinational company wanted to raise in Indian rupee. They want to raise Indian rupee. They want to issue deposit receipts in our country. So who are the buyers? We are the buyers. We can buy this Indian deposit receipts. ADRs, GDRs, Indians cannot buy. We cannot buy because we are not entitled to buy. It is only for an outsiders. It is only for foreigners. Okay. But Indian deposit receipts issued by foreign multinational company in our country to raise Indian rupee. So only one foreign multinational company has issued IDR so far, Standard Chartered Bank. So Standard Chartered Bank has issued IDR, but 2 months before, IDRs have been abolished in our country. It is not there currently. Why? Because no companies are coming forward to issue IDRs. Then why to keep all these instruments? So Ministry of Finance has abolished the IDRs 2 months before. So no multinational company can issue IDR currently. So we do not have. So this is the equity form of raising funds. Equity form of raising funds in the foreign country. Now, debt form. We come to debt form. So when we come to debt form, we have bonds or debentures. We have seen that. We have seen bonds or debentures. Bonds are issued by the government-owned companies. Debentures are issued by private companies. That we have seen. Both are debt instruments. Now, Indian multinational company, say Infosys or TCS or Wipro or Mahindra and Mahindra, so all Indian multinational companies. So these Indian multinational companies, can they borrow from foreign banks? They can borrow. They can borrow from foreign banks. They can take the loan from American bank, or they can take the loan from Standard Chartered Bank. They can take loan. So when they take loan from a foreign bank, they receive in foreign currencies. They don't receive in Indian currencies. So for example, you go and take Indian companies go and take a loan from State Bank, they receive in Indian rupee. They don't receive in dollars. The same Indian multinational company, if they borrow from foreign banks situated in foreign countries, then they receive in dollars. That is called external commercial borrowings. External commercial borrowings. ECB, external commercial borrowings, ECB. And Indian multinational company issues bonds within the country, it is called bonds. But same bonds issued in foreign countries, it's called foreign currency convertible bonds, FCCB, foreign currency convertible bonds. Foreign currency convertible bonds are issued by Indian multinational companies in foreign countries to raise foreign currencies. Foreign currency convertible bonds. Foreign currency convertible bonds. Convertible bonds means it can be converted into equity. Okay, so at some point of time, why it is convertible bonds? At some point of time, the companies could not pay its principal amount, because bonds, as all of us know, the bonds, the money need to be paid back after the maturity period, and moreover, the companies need to pay interest in foreign currencies. For example, if it is issued in UK, we have to pay in pounds. If it is issued in Japan, then you need to pay in yen. Okay, so in foreign currencies, we need to pay the interest. So if the company could not pay its principal amount or interest, and the company can convert these bonds into equity. That's why it is called convertible bonds. Okay, so foreign currency convertible bonds are issued by Indian multinational companies in foreign countries to raise foreign currencies. That is called foreign currencies convertible bonds. Okay. Now another innovation. So they're all innovative products what we have in a global market instruments, because all this innovation is required for the companies to move forward for diversification and growth. Another innovation is if the company, so for example, when you issue bonds outside the country, you receive dollars, but we don't want to receive in dollars. Why we don't? If you receive in dollars, the risk is the currency fluctuations. See, when you issue, for example, if it is 75 rupees per dollar, and when the rupee gets depreciated, then what happens is you receive less dollar. The rupee gets depreciated, then when you pay interest, you need to pay more interest. Or after the maturity period is over, when the rupee gets depreciated, you need to pay more. Okay, so foreign currency fluctuation risk is always there with foreign currency convertible bonds. If the companies are given option, you issue in foreign country, but you raise Indian rupee. The option is given, then the companies will be more happy, because what risk is not there? The foreign currency fluctuation risk is not there. You issue in foreign country, but raise Indian rupee. Not raising in for dollars or yen or pound or Singapore dollars. But it is a foreign, issued by a foreign multinational, Indian multinational company in foreign country in Indian rupees. The previous one, foreign currency convertible bonds, issued by Indian multinational company in foreign countries, raising dollars or raising foreign currencies. The second form is issued by Indian multinational company, issued in foreign countries, but raising in issued in Indian rupees. That is called Masala Bonds. Okay? Masala Bonds. Why it is Masala Bonds? Because Indian cuisine is, so the name is given, Indian cuisines are a lot of spices there. That's why the name, it is given Masala Bonds. So Masala Bonds are issued by Indian multinational companies or Indian companies, issued in foreign countries in Indian currency denomination.